If I told you that there was a completely legal way to invest your money, let it grow for decades and decades, and potentially never pay federal income taxes on any of that growth, would you use it? Because that opportunity already exists. It's called a Roth IRA, and honestly, it might be one of the closest things we have to a financial cheat code, I think. It's not gonna make you rich overnight or anything, it's not a special investment that guarantees better returns, and it's not, exciting enough to constantly be trending on social media. But over 30 or 40 years, it will quietly save you an incredible amount of money. The basic idea is very simple. You contribute money that's already been taxed, you invest it, and then allow it to grow. And if you follow the rules, you can take the withdrawals and take that money out in retirement without paying federal income tax. That's really all you need to understand before we get into the more interesting part. Technically, the Roth IRA itself is not an investment. It's the account that holds your investments. You can buy ETFs, stocks, mutual funds, and other assets inside of it, but it itself, it's not the investment. So if you open the account alone, that doesn't make your money grow. You still need to actually invest the money you contribute into the account. But now this is why it becomes so powerful. Let's say you invest consistently for several decades. Over that time, you might personally contribute tens or even hundreds of thousands of dollars. But if you stay invested long enough, then the account could eventually go far, far beyond what you personally put into it, and that's the whole idea. A huge portion of your final balance could come from the investment gains. And with the Roth IRA, it's not only your original contributions that can come out tax-free. The qualified withdrawals that you take out of it can also include decades of growth without federal income taxes being taken from that growth. And that's what makes it so powerful. That right there is the real cheat code. You're not really using the Roth IRA to make your investments, perform better or whatever. Well, in a way you are, because the taxes make it perform worse after you actually take the money out. But you're using it to keep more of whatever your investments earn, like I said. And I can see how that difference might not look important during the first few years. If your investments make only a few $100s, the tax benefit probably won't feel like life-changing. But you can imagine the account eventually growing to let's say $500,000 or $1 million or even more. At that point, the tax treatment matters a lot more, because building wealth is not only about how much money your investments make, it's also very important to think about how much of that money you actually get to keep. And I really do believe that not enough investors pay attention to this as much as they should. Because when you think about it, in a regular brokerage account, you may eventually owe taxes on dividends or the interest and realized gains. That doesn't make brokerage accounts bad. They're the baseline for what you can get, and they're still extremely useful and give you the flexibility that retirement accounts don't. But a Roth IRA gives you a protected space where your investments can potentially compound for decades without creating the same federal tax consequences. And with the law of compound interest, the longer your money has to grow, the more valuable that space can become. And this is why Roth IRA is especially powerful for young investors, I believe. When you're young, you probably don't feel like you have much of an advantage financially. You might not have a high income yet, you might still be in school, starting your career, or trying to handle rent, food, transportation, you don't have a car, and everything else that's coming at you at the same time, and that's normal. I also went through that, and I'm still partially going through that. But we do have something that someone starting in their 40s or 50s definitely cannot buy, and that's time. The only thing young people have that no one else has is time. Because the money invested in your early 20s, or even before that, like some high teens, could potentially have 40 or 50 or maybe more years to grow. That means that even relatively small contributions today can be a lot more valuable than you think, and that much larger contributions made decades later. And it's simply not because the investment is better or you made better decisions. It's literally just because you had more time to compound. Let's picture two people. The first person starts investing early but only contributes a modest amount. The second person waits several years, begins earning more money, and then contributes much more aggressively than the young person could when they were young. The second person might eventually catch up, but they definitely have to work much harder because they gave up years of compound growth. And that's the part that people underestimate. Waiting doesn't only cost you the amount you could have invested, it also costs you all the future growth that money could have produced. A very famous example is Warren Buffett. He's made most of his money throughout his late life. When he was 59, he only, and I say only jokingly obviously, had around $4 billion. Now that he's 95, he has more than $150 billion. And we can see that because he has lived an extraordinarily long life, his wealth has followed that path as well. So when it comes to contributions, you can always contribute more later, but you can definitely not go back in time and give your money more time to grow. And there's another reason that the Roth IRA can be especially attractive early in your career. You might currently be paying a lower tax rate than you expect to pay later. This is the case for most people. If you're still building your career and your income eventually rises, paying taxes on your money today may be a better deal than delaying those taxes until retirement. And obviously nobody knows exactly what their future income will be or what tax rates will look like decades from now, but the Roth IRA gives you the ability to lock in today's tax payments and potentially avoid the taxes and the withdrawals later in life. And the tax flexibility that it creates is something extremely valuable. Imagine reaching retirement with all of your money in accounts where every withdrawal is taxable. Like, it almost wants to make you not get your money out of the account. Every time you need money, you may have to think about how that withdrawal affects your taxable income. Now, imagine having part of your retirement savings inside a Roth IRA. Like, you'll be able to take money out of that account without adding federal tax income in the same way, which also gives you more control over where your retirement income comes from and how you manage your taxes. So, the Roth IRA isn't only useful because it can save money, it can also give you more options later. And the options eventually become incredibly valuable when you don't know what the future tax laws, expenses, or any personal circumstances that you would have will look like. Another important part of the Roth IRA is that your contribution space is limited. You can't wait until you're 50, realize how valuable the account is, and then deposit all the money you had into it all at once. They did have to kind of nerf this account because it's really powerful, and there are annual contribution limits, and once the opportunity for a certain year passes, you generally can go back and recover all of that unused space later. That makes each year extremely valuable. I feel like when people say they'll start using a Roth IRA once they make more money, they're assuming they can easily make up for the lost years, but that's just simply not the nature of the account and how it works. You may be able to invest more in the future, but you can't fully recreate the tax advantage space that you chose not to use. Like, think of every year as giving you a limited amount of space inside a tax-free container. You can fill some of that space, fill all of it, or leave it completely empty. But once the window closes, the specific opportunity is gone forever. This doesn't mean you should destroy your budget just to max out the Roth IRA, obviously. I'm not saying you should do that. You still obviously need money for your normal expenses, your emergencies, and other normal goals that you might have. But it does mean that contributing something can be much more valuable than waiting until you can contribute the maximum amount. I really don't know why, but often in investing, people have an all or nothing mentality. They think, I can't max it out, so there's no point. But that makes zero sense if you think about it. Like, you wouldn't refuse to save $1,000 because you couldn't save $7,000. The $1,000 still counts. That money still counts. That time it has to grow still counts. And most importantly, you start building the habit. Once investing becomes something that happens automatically every month, it becomes much easier to increase the amount later. I want to talk about what you should actually own inside the account as well. I personally don't make this complicated, and I don't think you should either. For many long-term investors, a broad index ETF, an S&P 500 ETF, or just like a total market ETF may be more than enough to form the core of the account. These funds allow you to own pieces of many businesses instead of depending on one company to perform well. And I explain ETFs in more detail in my previous video, so I'm not going to spend too much time on them here. Just know that that's probably what I would start with. The important point is that the Roth IRA works extremely well with a simple long-term strategy. You don't need to constantly look for the next hot stock, you don't need to trade every time the market moves, and you definitely don't need to rebuild your portfolio every time someone online announces like a new opportunity or something like that, which is common nowadays. The Roth IRA is most powerful when you give your investments time. Ironically, the more you constantly interfere with the account, the less likely you may be to receive its full long-term benefit. I don't know why, but people treat investing like they need to be doing something at all times. They feel like buying and holding is too simple and boring, which it could be, but it's just the best way to do it. They have the urge to research new stocks, predict market crashes, sell before the downturns, and buy back in the perfect moment, but we all know this is impossible. And the purpose of a Roth IRA isn't to create excitement. Its purpose is literally to quietly compound money over a long period. And one of the worst things you can do is turn a long retirement account into a gambling account. Yes, successful investments inside a Roth IRA can receive incredible tax treatment, but that doesn't mean you should fill it with the riskiest investments you can find. The tax advantages don't protect you from losing money. Losing money tax-free is still losing money. And because your contribution space is limited, a major loss of your money can especially be painful. You can't always immediately just replace that lost tax advantage space by depositing unlimited new money. That's why many people choose to keep the core of their Roth IRA relatively diversified and focus on the long term. And I personally think that this should be most people's kind of like safer investment just because of the advantages that it has. And then if you want to go gamble or like, research your own stocks, then do that outside of this account, even if the tax advantages can be very tempting. Another surprisingly common mistake is opening a Roth IRA, depositing money, and never investing it. Even as silly as that sound, I promise you this is what a lot of people are doing. And it's really just because of a lack of education, and this person might be thinking they're finished because they already moved the money to that account and it's transferred there. But the cash is just sitting there, and that's why they don't realize. They check the account years later and wonder why it barely grew. And the Roth IRA, you have to think about it only as the container. You still need to choose the investments that go inside of it. So whenever you contribute, please make sure that you know whether the money is actually invested or just sitting there in cash. Another big mistake is waiting for the perfect time to enter the market. People worry that the market is too high all the time, that a crash might be coming, or that the economy looks uncertain. This is always the case, always throughout the whole history of the stock market. There is always something to worry about. Recently it could be whatever, an election or a recession prediction, a war, interest rate decisions, or someone confidently explaining what the market is about to collapse. Some people can be very persuasive. And if they convince you and you wait until everything feels completely safe, you actually may never invest. For a long-term investor, consistently contributing over many years is generally way more realistic than trying to predict the perfect day to invest. The purpose is definitely not to buy at the lowest price of your lifetime. The purpose is to own productive assets for decades. Now, you may be wondering how the Roth IRA compares with a traditional IRA, or you didn't even know that traditional IRA existed. The main difference is when you receive the tax benefit. With a Roth IRA, you generally pay taxes on the money before contributing it. In exchange, qualified withdrawals later can be tax-free. With a traditional IRA, on the other hand, you may receive a tax deduction for your contribution, depending on your situation, but the withdrawals are generally taxed in retirement. So the simplest comparison is this: like with the Roth, you pay taxes now and potentially avoid them later. With the traditional IRA, you may receive a tax benefit now and pay the taxes later. Neither one makes it automatically better for everyone. It just depends on your current tax rate, expected future tax rate, income, retirement plan, and your personal situation overall. But for young investors who expect their income to grow over time, the Roth IRA can be extremely attractive. You may be paying taxes during a lower income part of your life and then receiving the benefits during retirement after decades of potential growth. That's why the Roth IRA deserves more attention than it gets. It isn't flashy, it doesn't promise you like the fast money, it won't give you the same excitement as buying a stock that doubles in a month, but it does something much more dependable, and that's that it rewards your consistency, your patience, and the long-term thinking that you might have. You can contribute when you can, you invest the money, you avoid constantly interfering with it because that's what is going to mess it up, and then you allow decades of compounding to do the heavy lifting. Now, having said that, the Roth IRA won't make you wealthy by itself. You still need to earn the money, control your spending, make a budget, contribute consistently, and choose reasonable investments like I said, but it gives all of those efforts a major advantage. It allows more of your investment's growth to remain yours. And after 30 or 40 years, that could make it one of the best financial decisions you ever make looking back. So here's my challenge to you. If you have earned income and don't already have a Roth IRA, please spend a few minutes this week learning whether you qualify and how the account fits into your financial plan. Again, it might sound silly, but if you already have one, please check that the money inside it is actually invested. And if you can't max it out, don't use that as an excuse to do nothing. First, start with an amount that fits your budget, because the biggest advantage you have isn't finding the perfect stock. It's giving your money as much time as possible and then not having to pay taxes on that huge effort that it made. So please go open one. I guarantee you your future self will thank you so much and immensely for this. And if you found anything in this video helpful, please like and comment and subscribe. I would love to see this community grow and be able to help people achieve their financial goals. So thank you so much for watching, and I'll see you in the next video.